Hey there, everyone. Happy Wednesday, January 28th. I'm Dave Keller with Market Misbehavior. Thanks for coming or joining us here today for the show. We're coming to you from a kind of drizzly, classic winter day here in Redmond, Washington. Hope you guys, wherever you're at, are surviving the great frosty, cold experience, wintry experience here in North America, and doing well. Fed Day today ended up being much ado about nothing in terms of the overall market environment. However, the S&P 500, no, didn't do it. It actually traded above 7,000 enough that I actually got the horn out. I have it sitting here on a stand next to my desk, but it's not time yet. We did not close above 7,000. We opened right up to that big round number threshold that we've been unable to eclipse yet, and then sold off in the morning session. A lot of movement around earnings. We've got some of the big, magnificent seven names: Microsoft, Meta, Tesla, all reporting results here after the close. Looks like Meta gapping higher on results, Microsoft trading lower on results. A bunch of things doing similar movements to the upside and downside. We'll do our best to sort of help you understand the market conditions here as we get through the first Fed meeting of 2026. What you're going to find is this was not a big resilient up move related to any sort of Fed policy changes. Not much in terms of, no change to the target rate. And in general, I think investors left waiting to see when that next rate cut may come down the road. We've got weaker breadth. We've got 9 out of 11 S&P sectors down. And again, the S&P for now struggling to gain a foothold above the 7,000 level. Let's look at some charts together, shall we? We'll start with the S&P 500. There's the open pushing just above 7,000 in the first 30 minutes, but that was the high for the day. We ended up closing pretty much almost exactly at yesterday's close. I mean, the S&P was 0.01% off of where we closed on Tuesday. So we finished the day around 69.78. The Dow did close about the same, 12 points higher, just above 49,000. NASDAQ slightly higher as well. Even mid caps and small caps, which were weaker, weren't down by much. So again, the volatility remains low. The VIX remains just slightly above 16. This is a low volatility environment. That is the reality of where we're at. Looking elsewhere, we can see interest rates, again, moved higher after the Fed meeting today and really through the course of the trading day. The 10-year yield actually sold off, the 10-year yield dropped, which means bonds rallied after the Fed meeting. So bond markets closed at 3 p.m. Eastern. So that last 30 minutes, which is after the 2:30 p.m. And the 2 o'clock announcement and the 2:30 press conference. Bonds rallied during the press conference, so rates finished down a bit, but higher for the day. So the 10-year yield almost exactly at 4.25%, and the long bond yield approaching 4.9%. By the way, I had a really good interview with Simeon Hyman of ProShares. My editor just got that back to me before we got started here, so look for that. Hopefully in the next hour, I'll get that posted to my YouTube channel. I might be tomorrow morning now that I think about it. Given a bunch of things I'm going to try to do, but I'll get it out to you shortly. Please check out that interview. He did a great job covering a lot of different macro themes, how to think about interest rates, the dollar, U.S. versus non-U.S. Not as much of a technical conversation, but more of a macro thematic conversation. But Simeon answered so many of my questions very eloquently, and I think you'll enjoy that interview on the Market Misbehavior podcast. The dollar popping up a bit. The administration talking about how they love a strong dollar environment in some ways, right? And no reason why they want to push it lower, right? Why would you think that? So the dollar index, which has been trending lower for quite some time, having a nice bounce today on comments from Treasury Secretary Scott Bessent. So dollar index moving up a bit here, reversing that general downward trend that we've been observing. Gold, silver, crude oil, all having decent up days. That uptrend in commodities continues. The dramatic outperformance of commodities versus stocks continues. One of the charts that I'm going to share with you is the stock to gold ratio. I read an article this morning, and man, I meant to note who it was. The strategist at Stifel, I want to say, but I don't really remember who it was. I apologize so much, whoever that was. But I read a lot of stuff randomly and talked about the stock to gold ratio. So I brought up one of the charts that I've looked at before and tweaked it a bit just to show you visually what that relationship can mean. A lot of times that relationship gets very low because stocks are going down so much. In this case, it's stocks are doing fine. It's just gold has been going up so much that in gold terms, the S&P is actually remarkably weak, right? Cryptocurrency is very mixed. You can see Bitcoin kind of a choppy session, did tease that 90,000 level and push slightly above it, but currently trading just above 89,000. Ethereum down slightly, and the rest of the top 10 coins kind of mixed right about now. Looking at the 11 S&P sectors, almost all of them down today. Technology and energy are the two upside outliers. The XLK, technology was up 0.8%, about the same for the energy sector, the XLE. Everything else was down. You can see consumer staples down 1%, consumer discretionary down 0.8%, and real estate down about 1% as well. So, at the top, it's sort of a mix of technology, which is a pretty growthy sector. There's a lot of earnings in the technology sector today. And some names like Seagate, STX, just continuing to rip to the upside like they don't even care. I'll show you that chart here. It's going up and to the right as it has been for quite some time, but enough to push technology higher. We'll look at a couple of those charts. Energy as well, continuing to impress here. Some of the big energy companies reporting on Thursday and then Friday of this week. All right, looking at breadth was not great today. So while the breadth generally has been positive recently, we're starting to see a downtick in breadth conditions this week. We're back to growth over value, at least, the last couple of days. And the weaker breadth conditions sort of match that, right? We're going back just at least briefly to the technology dominance that we experienced through much of 2025. We've seen a very different read in the last couple of months, but days like today, breadth weaker, technology up, the market kind of flat. If you look at the major index like the S&P, about a 2-to-1 ratio in most of the indexes of stocks down versus up. So this is more of a distribution day in terms of the stocks actually moving lower. All right, looking at the Magnificent Seven and friends, NVIDIA having a nice bounce up about 1.6%, outperforming the S&P. Alphabet, Microsoft in the green as well, but not by much. On the downside, Netflix continuing to underperform the market and underperform this basket of stocks, down another 1.1%. Apple, Amazon, both down about 0.2% as well. All right, shall we look at the heat map? As we do so, please take a moment, if you feel so led, and drop a question in the comment section on our YouTube channel. We'll do an all mailbag episode soon. I'm hoping on Friday I can swing one, and would love to answer one of your questions as part of that episode. Any question is fair game. And again, the last couple of weeks, we've had some really good mailbag episode featuring questions from viewers like you, just taking a moment to share a question about a particular chart, about a particular indicator, anything we talk about on the show. I'd love to hear from you and what questions come up, and helps me to think about what areas we should cover a little bit more. Looking at the heat map again, this is a great visualization, giving you sort of a couple layers, right? The top down kind of high level, what's the big picture, and then the macro or micro kind of small level, really getting an understanding of individual names and themes. So a couple things to highlight in terms of things working well. If you look in the upper left, technology, honestly, very mixed, right? And you can see like a Palantir and Amphenol, Skyworks all down pretty good today. APH down 12% today. That's a big drop after making a breakout earlier this week. That's coming off pretty good going into, I think they had earnings yesterday or this morning. We can see elsewhere stocks like Micron continuing to push to new highs. I mentioned the hard drive names, Western Digital and Seagate. These have accelerated to the upside, given all the demand for storage and things that they tend to be pretty good at. Intel, Texas Instruments having nice bounces higher as well. So this is very much turning into one of those markets where it's the haves and the have-nots, right? The stocks that are really starting to flourish or continuing to flourish, and some of the ones that are struggling quite a bit. So it's quite a diverse set of returns if you look at technology today. Not as much if you look at sectors like consumer staples and real estate, which are two of the weaker sectors today. Again, none of the S&P sectors were down an aggressive amount. But that's where you can see most names are actually moving lower. This is very much a rotation back toward offense, away from defense. That's an emerging theme we've been talking about. I'm looking for any sort of improvement in defensive sectors, which usually tells us we need to be a little more concerned. Didn't really necessarily see that. But of all the sectors on the heat map, I would say the one that's most concerning now is healthcare, right? And you have Danaher is one. I actually think I grabbed that chart now that I think about it. Yeah, I did. So I won't talk too much about it. This is an earnings name, but Danaher is one breaking down through initial support. I'll hold my thoughts until we bring up that chart, but it's not just that one, right? You have like an Amgen, making new highs here, but on weaker momentum. So we're starting to see some divergences with higher prices on lower momentum. And healthcare, again, had been one of those really encouraging sectors going into 2026. And now we're starting to see a bit more of a risk off move in some of these names. And it's not just one group. It's sort of a mix of a lot of them. CVS comes to mind as a classic example of a failed breakout, or maybe call this just a major double topping pattern, right? So, we have a resistance in October. We basically got all the way right back up to that previous resistance, and then a gap lower, and then today a nice bounce off the 200-day. So that's encouraging. But is this the buyable dip that pushes us a bit further? CVS is actually a really interesting chart because here you have a hammer candle as we test the 200-day. This is actually a bullish harami pattern, which is a big down day and a smaller up day. That's a 2-bar reversal pattern called a bullish harami pattern. Today we have what you would call a bullish piercing line. Don't get that one too often. Let me make this a candle chart so we can see that a little more clearly. All right, we'll zoom in a bit. So let's look at all these tests, right? So here we have a hammer candle, which is the open and close near the highs of the day, long lower shadow, little upper shadow. That's a short-term reversal as we test the 200-day. Here we have what's called a bullish inside day. If you use bar charts, if you use candle charts, you call this a bullish harami pattern. It's a big down day and then a smaller up day, where day one engulfs day two. That's a 2-bar bullish pattern at the 200-day. And today, we have an example of what's called the bullish piercing line. This is a 2-bar or a 2-candle pattern, a down day and an up day. Day two has a lower open, and the close is at least 50% of the way through that first candle's body, which is the high open to close range. So this is just at a bullish piercing line. You get a similar one kind of back here. Big down day, big up day. We close at least halfway through the first bar's body. That's telling you the next couple bars should most likely be higher. So, CVS gapping lower on Tuesday. Today, that bullish candle pattern suggests maybe we get another bounce off of the 200-day, which we've seen a number of times. Interesting one. I might save that chart to refer to. We might track that through the course of the week. Keep an eye on energy, by the way. Crude oil prices, which have been so underwhelming, really starting to rotate higher as the dollar generally has been weakening. A lot of earnings in that space Wednesday, and then especially into Thursday, and then Friday. I think Exxon and Chevron are set to report on Friday. All right, that's it for the heat map. Shall we continue and look at some charts together? So again, these are charts. The way I find charts for the show, by the way, is I'm looking at charts all day for random things. Something comes up, a premium member asks about something or whatever, and I look at a chart. I'm talking to someone, it comes up, and anything that catches my eye, I save it on the list. And by the end of the day, I've got a pretty good list of charts. I refine it a bit, of course, but in this time of year with earnings for the fourth quarter, there's just way too many charts to look at in a brief market recap show. So I try to just grab some and review some interesting ones that seem actionable or interesting. Starting with the chart of the S&P 500, I'm here to tell you that we remain in that green region. We remain in that green light. If you think of the market conditions as a traffic light, which I think is a good, just kind of fairly simplistic, very straightforward way of thinking about market conditions. S&P above 6,900, I think, is in pretty good shape, at least for now. We're back above the 50-day, back above the 21-day EMA. I think that's all encouraging. The moving averages are all sloping up. Anything above 6,900, I'm inclined to think at this point is pretty good. The yellow light would be anything between 6,900 and 6,550. That would imply a short-term pullback, but that the long-term structure is still in good shape. Anything below 65.50 tells us we're breaking down, and that's a weaker environment that we probably want to avoid and or start to get defensive. The momentum remains just dead neutral, right? With the RSI rotating around the 50 level, it's kind of bouncing between 40 and 60. So we have even momentum, right? So even balance between up days and down days. And the question is, which way does this resolve? The trend is going higher, but the momentum really not supporting a lot of optimism right here. So we'll see. We can get further upside, break above 7,000 on stronger RSI readings. That would clearly be the most bullish way to see what's going on. I mentioned the weaker breadth conditions, and to be clear, the breadth is still good, right? I mean, the long-term breadth is great. We have 67% of the S&P members above their 200-day. That's a great number. We have 62% above their 50-day. That's a pretty good number as well. But, again, I think the way that I think about charts, you think about different timeframes, right? The long-term timeframe, undeniably great, right? Market's going higher. Weekly chart looks good. Our market trend model's bullish. I think it's fine. But in the short term, we always look for initial signs that maybe something's changing, right? I think that's the game. Right? You sort of make your, you evaluate the conditions, you evaluate the evidence, you place your bets, and then you start to, again, consistently and systematically review the evidence for changes. And the reality is big changes are always reflected on the short term before they're reflected on the long term, right? A big top always looks really obvious on a daily chart or an hourly chart first. That's where you start to see things are getting rough. The weekly chart often takes a little bit longer because you're bringing in more data. You're looking at a longer time frame. It takes longer for that chart to look less awesome. And so the benefit of looking at short-term breadth is we can start to say, all right, are there any short-term changes which could evolve into something more significant? It's too early, I think, to say that that's what's going on, but I am noting that as the S&P is trying desperately to get above 7,000, we've got less and less stocks above their 50-day moving average. We documented that quite a bit last summer, right? When you think about May, June, the S&P was going higher on stronger momentum. Then you get to like July, August, September, and the momentum is just kind of weakening. All the way through the end of October, those new highs were met with weaker momentum readings. And we're starting to see just a bit of that kind of divergence here. It's too early to sort of declare it's an obvious divergence, I would argue, but just something initially to think about. And again, I think that speaks to the fact that it's not sort of the broad advance, at least this week. This week, it's more about kind of the big growth companies recovering a bit and popping higher. Now, the Chaikin money flow is one of the ways I like to assess volume conditions. This indicator, if you're not familiar, uses a 21-day look-back period. So it's basically saying over the last month, what's the volume as weighted by volume on up closes versus down closes. And it's a little more nuanced than that. It actually looks at where the price ends, the closing price versus the high and the low. So it really looks at every trading day and weights the volume based on where we close in the range. So if the Chaikin money flow is right around zero, which is where it is, that basically means when you look at the volume, there's volume on up moves and down moves, and they're generally even. There's no real dominance from one side or the other. And what you would want to see, if you're all bulled up, is more like what we saw in May, June, July, even September, where we saw the Chaikin money flow very strong. That means looking back at the previous month, we've seen a lot of accumulation. We've seen a lot of big volume on up closes. We're not seeing that now, right? And actually the current reading is slightly below zero, which basically means it's even. There's up closes and down closes over the last month, and the volume is really not clearly bullish or bearish. So it's a concern, I would say, a little bit, right? Because we're not seeing the strong volume. And if you just simply look at the trend in volume, by the way, since that gap lower, that was on that Tuesday of the MLK weekend, right? That Tuesday we came out of that weekend with the gap lower, and then we sort of bounced from there. From that bounce, look at how the daily volume readings have been lower and lower. So we've seen less volume on this little rally, and that's enough, based on the indicator to suggest kind of neutral volume at this point. I would say not the bullish volume you may want to see. Volatility still remains quite low. We did spike up to around 20 on that sell-off a week ago, Tuesday, but volatility came right back down. Anything below 20 is a low volatility environment. And so that's telling me market's pricing in small movements in the S&P, which is exactly what we see on a day like today. Rates going up, that's been a trend we've been observing since October. That was a question I asked of my guest Simeon Hyman of ProShares. Again, look for that episode here very soon, hopefully later tonight or tomorrow morning. I just need to spend some time getting that all ready for you, but really great interview. Simeon's a smart strategist and a really knowledgeable expert on a lot of different macro themes, and it was really fun to ask him about dollar weakness, what that might mean. Less of an issue than you might think, according to Simeon. Higher rates, what that means. He actually had some really interesting perspective on what the short end versus the long end of the curve really tells us, and how to think about these movements this week. So bounce higher in interest rates is something to watch. And the way I think of it, it just makes, depending on who you are, borrowing money is just getting a little bit more expensive as that trends higher, and to a lot more expensive. And that starts to weigh on consumers at some point. I'm still not that high relative to where we've been over the last 2 years, but trending in that direction. The dollar has been rotating lower in the last couple of weeks, and that has been a great tailwind to commodities, particularly crude oil and gold. Gold, we were talking 2 days ago about the close above $5,000 an ounce for the first time in history. Today, we traded almost to 5,400. So we're up, we're up a decent amount just since we had that threshold broken 2 days ago. So the acceleration to the upside is certainly very much there. Weaker dollar, stronger gold certainly has a safety trade kind of vibe, in my opinion. Although there's a lot of reasons why gold can go up, and certainly gold was strong last year, even though stocks were strong as well. But at this point, certainly going parabolic in a lot of ways. Crude oil price is going higher. The crude oil future made a new 3-month high this week. It hasn't happened in a while, and so I'm noting that strength in crude oil going into earnings. I think that's going to be a key thing to watch. All right, again, I apologize. I read a lot of articles and watch a lot of things in the course of what I do, and I try desperately to remember and attribute insights and ideas from whoever originates them. That's important to me as a creator, to recognize other people doing great work, because there are a lot of people, making some really good points about the market. And I apologize whoever made this great point in whatever article. I just was reading too many things at the time. But it was talking about stocks versus gold, and just thinking about, they were describing it as looking at the S&P 500 in gold terms. And one of the ways I do that, just in a very simple ratio, is looking at the SPY versus the GLD. If you think about it, the S&P 500 is denominated in index points, basically, right? But we think of it in sort of dollar terms, right? When the S&P is going higher, it's going higher in dollar terms, right? Because it's comprised of these stocks that are all priced in US dollars. By dividing the price of the S&P 500, which is you see in the top, when you divide that by gold or a gold ETF, what you're basically doing is now looking at the S&P 500 in terms of gold, right? How much gold do I get for the S&P as opposed to how many dollars I get, is the way to think about it. So even though the S&P 500 was trending higher off of the April lows, and even though the S&P in terms of gold was actually pretty good going through July and August, that's what it usually looks like in a bullish market environment, right? The S&P is going higher in value, and you often have the S&P going up in terms of gold as well. However, we're now getting a huge divergence, which is just absolutely accelerated in the last 6 months, where the S&P in terms of gold has been going down quite a bit. So it's actually been losing value in terms of gold. And that is less because stocks have been struggling. Stocks, as we know from the S&P, is doing fine. But in terms of the real value of the index, the S&P is going down. So the problem is, it's sort of like looking at the S&P 500 in real terms. It's like what your index actually mean, right? What it actually represents in terms of the value of the dollar, because the dollar has been weakening in terms of gold, because the S&P has been trending higher, but gold has been strengthening so much. So the S&P has actually been going down in terms of gold value, and gold is more of a hard asset, more of something real and that has value, a good store of value. So it's not good. Now, if you look to the left on this chart, and if you go back through longer periods, you'll see this happens quite a lot. When the S&P is going up, you usually have the S&P going up in gold terms. But when we start to get that divergence, it usually doesn't end up well for the S&P. We often get big sell-offs. And I think most noticeably on this chart, look at the first couple months of 2025, while the S&P is holding up, while the S&P in gold terms is trending downwards. And that looks very similar to what I'm experiencing now in the last couple months, right? The S&P is making new highs trending slightly higher, but the S&P in terms of gold is going down quite a bit. And that usually implies that the value is not as awesome as it looks, and there's something else going on here. So that is a great, an interesting way of thinking about it. This divergence usually doesn't end well for stocks, and usually implies some safety trade or people obviously rotating into a stable store of value. That often means that stocks are coming down soon after. Of course, we'll track all of those charts along with you to see if we get any sort of breakdown, but something to think about. The S&P in real terms is how I would describe that. All right, lightning round style. Let's look at some of these stocks reporting earnings. Danaher is a healthcare name. I highlighted in the heat map some of those healthcare stocks that are struggling. Just today, one of the worst performing sectors, and we're seeing some weakness there. DHR is one that was down after reporting before the open today, down almost 5% at the close. And the problem is this is a chart, excuse me, that looks very, very good going into this week, right? We're making higher highs and higher lows. The momentum is pretty strong. But look at what's happened with the weakening momentum today. We closed below the 21-day EMA and closed below the 50-day moving average for the first time since the September low. Recovering the 50-day on a chart like this, I would argue, is pretty important. We've seen that with things like the S&P below the 50-day, but getting back above it is usually a really good sign. That's what you'd want to see here on the chart of DHR, but for now, in a position of weakness. Seagate Technologies continuing to just accelerate to the upside. Obviously, a lot of demand for STX and WDC and their products. We're seeing the prices reflect that. This was an earnings name yesterday or earlier this morning. I forget if it was yesterday after the close or earlier this morning, but up 19%, which is a pretty nice continuation of that uptrend phase. So long and strong up and to the right. All right, we've got a couple names that are actually reporting after the close. So let's check in on these. Lam Research is one of those semiconductor names, while NVIDIA, like AMD, have pulled back. LRCX is one of those examples that looks a lot like a Western Digital and Seagate, just these nice, consistent uptrends. So the question going into earnings, does that further validate the strength of this trend? Because the price is going up and up and up. The PE ratio is most likely going higher and higher. The earnings growing to justify that increased valuation, or to make that valuation seem a little bit more reasonable. Looks like after hours we're up about 3.7% to 248, which means we're kind of up here a little bit. So it looks for now like a pretty decent report and a nice uptrend. Again, when you have a stock doing that, most likely the relative performance is pretty good, and that's exactly what we've seen on here. Charts like this with the price above upward sloping moving averages, that's a strong uptrend getting stronger. Something to be excited about. Microsoft, one of the three Magnificent Seven names reporting earnings today. So Microsoft is one of those that broke below its 200-day moving average, has since reversed a short-term reversal, getting right back up to the 200-day, and today traded right almost to the penny to the 200-day moving average before pulling back a little bit. Let's see what happens. So Microsoft getting dinged in the after hours session, down around 457, which means it's currently trading down around here. Now, again, standard disclaimer, right? The after hours session, a lot less participants, a lot less liquid. It's good for like instant reaction, but we'll see what happens tomorrow. But if we would open down in that range, that would be a big, 5% lower open if we'd been down that range. And I think the question still remains. I think this is a chart that looks pretty interesting if and only if we can get back above the 200-day moving average. That's what we're looking for on this rally. If we get an earnings miss that causes the price to come back, that just tells you it's not there yet. And the RSI stalling out below 60 in that situation, which is not good either. Meta, very similar to Microsoft. These are the two names testing the 200-day from below. Meta is actually testing resistance from December as well. It looks like we're up pretty decent, as I saw and mentioned earlier, up to 725. That's up about 8.5% in the after hours. Currently trading around here. 725. And if we would open up in that range, that would mean well above the 200-day. That would mean stronger momentum. That'd be a pretty nice resolution of this consolidation phase, right? Think of this as a period of distribution. We have what I call a consolidation phase, right? A range-bound market. And then this potentially is a gap higher. I think that'd be a very bullish development, assuming that's where we open and if we continue higher. Tesla is the third Magnificent Seven name reporting back below the 50-day moving average this week. Looks like to after hours, we're up to around 445, which means we're almost exactly right at those moving averages again. You want to see this get back above moving average resistance now that we're below there. Want to see much more positive momentum. It's been dead neutral. To be determined. We'll see what happens tomorrow. Starbucks reported earlier today the open was strong. It traded up to almost $105 a share, but by the close, all the way down to 95. So this is what we call a gap and fail pattern, is what I would call this, which is like a gap higher, but it absolutely, I mean, we didn't even hold yesterday's range, right? We actually got down and closed back at the lows of yesterday. So an initial gap higher at the open met with quite a bit of selling. This is after being in the overbought region. So, what does this tell you in terms of the short-term sentiment? Well, it tells me that stock has been in a pretty good uptrend so far year to date. Today's gap higher was super encouraging, but just people sold into that gap higher heavily, and we're back down below there. So not a bullish outcome in terms of post-earning reaction. I think that's a kind of a concerning development on the chart, a gap that does not follow through to the upside. Folks, that'll do it. That's a rundown of some of the key charts, just a few of the names reporting earnings. There's quite a few. So if we missed one, if there's one that you want to look at, please take a moment, drop a comment on our YouTube channel. Let us know the ticker and what you're seeing. We'll do our best, hopefully, to take a look as well and review. That's it. Watch out for episodes of the Market Misbehavior podcast. A good one coming your way here shortly. And I'm speaking with John Kalovis tomorrow from Macro Risk Advisors. John was one of my analysts at Fidelity. He is an exceptionally talented technical analyst. I caught up with him down at the Tampa event with the CMT Association. Super happy he'll be joining us on the show tomorrow. Look for that later this week. In the meantime, have an awesome night. Remember, it's always a good time to own good charts. Have a good night, folks.